Hello, everybody. Let's have a good week. Alexander, how are you? Brock, someone's typing very quickly.
That was me.
You have skills. Hi, Brock. How are you? I'm looking for a secretary. Hello, Hugo. And Mr. Gorshi, how are you? And Ryan, 195 words a minute.
All with one finger.
And I'm not talking about typing. I'm talking about talking. You can talk pretty rapidly. Anyway, how's everyone doing? How's everyone doing today? So let's take a look around. I'm looking for a high in the WTI this week. There's kind of a look, it's not classic, we're diverging, but this could be a 3 drive setting up here on a 4 hour. 2 hour is confirming. 1 hour diverge. Shorter term stuff is diverging up here, like the 15-minute. So anyway, I'm thinking there's a chance. There's nothing on the daily, and you know what? Even if we get a good solid hard break, it's happening at a confirmed high. So this is breaking some of my rules. But I actually think there's a shot to pull all the way back towards this 50-day moving average over the next couple of weeks. Interesting place for stock indexes to take a pause, especially since it looked like we came out of here. I'm not sure, maybe this is something like 61.8 back or 78.6 back, and NASDAQ's not quite as weak. And, we stalled at the 15.2. To me, last week I talked about 14.9 being a big area, and we broke out. So in order for this uptrend to continue on, any pullback should hold a couple hundred lower here. So we'll see what happens here. As far as the currencies, haven't seen this for a while. Cable weaker than euro. Okay, so euro looks like, it's going to come out of here. I'm not looking for a huge bull market, but I don't know why we can't see, maybe 117 or so. And the Dixie, I still think it has, after last week's off number, I still think there's some more downside. I'm not looking for a crash. Who knows if we'll even get to 93.50. You can't even think about getting long-term bearish until we negate the breakout. What are you thinking, Ryan, coming into a new week? What do you? I know that you're a pro and you're thinking about things all the time, and most likely over the weekend you probably have some kind of plan for things that you're looking to do. What are you looking to do this week?
Yeah, I think we're going to be looking at probably round about, well, what everyone's looking at the moment, rates at the moment. Got a lot of talk this morning in the news about BOE's Bailey talking about rate hikes and the market inferring that means November, which is forward from December as they were thinking the week before. So we've had a big shift in money markets and pricing of interest rates, but it's not reflected across into the pound. I think the pound already made its move on that last week. But we're now seeing this gradual shift across the interest rate universe, if you like. The ECB is now expected to hike 10 pips by September 2022. Last week it was by December. So this gradual shift in the rates is weaving its way into the market, and I think that's going to be the deciding factor. But FX not really paying much attention to it at the moment.
Yeah,
which is a bit of a surprise, perhaps. But as I say, we've had all that pricing and the expectation last week, so I'm not sure what more it's to give. And also, markets, I think, are not really seeing a big, massive, rate hike cycle coming. But there's some in the market who are pricing it. We're pricing Bank of England rates to be 1% by August 2022. That's even pre-crisis rates were 0.75%. before the virus. So, we're going above and beyond. And I think that's where we might start to see some trades coming. That's what I'm going to be looking for if these markets get ahead of themselves in these rate expectations. Maybe they go too far. We see the pound running, really high on those expectations. Then perhaps we got a little possibility of fading that if they go a bit too far.
What do you think of Euro Pound finally making new lows for the move without any follow through so far?
Yeah, well, this is going to be interesting to see if it holds below this 84.50 area, which was that prior low.
Yeah.
If we can stay below there, I mean, you got the trend line in there, and we're just above it now. But
Yeah.
if we can stay below that low, that's a start. If we get it back above that 70-80 level, I'm going to start kicking the cat. But it never moves fast.
Yeah.
I said exactly the same thing the last few weeks. If it does break 80 and then breaks 50, it probably run into a brick wall 20 pips later, and here we are doing exactly that. But
yeah,
small steps. The trend continues, as you can see. We had a bit of a pause there. Had a bit of a brick wall. We've broken through the brick wall around 80-70. It keeps the bearish pressure on, and as long as we stay below, then I expect further downside to come.
Okay, because it kind of looks on the daily like, I know it's real stretched out, but it's still in form as a 3 driver, and we did not confirm lows at the breakdown level. I'm not sure about other time frames. Yeah, almost diverging here. I'm sure short term it didn't. Yeah, see, this is confirmed, so maybe it has some more work to do. Any feeling on the metals, Ryan?
Oh, they had their little pop again. Short-term move that sucked everyone into all the bulls thinking they got away with it, and here we go again, and they've been spat out again.
Yeah.
And I think unfortunately we're gonna get back into the bit of sideways action again, seeing what rates are going to do. I think the US, you guys coming to town now. 10-year yields are ticking up again above 160. That's have we washed out last week's wobbles and now starting to build again. We've got to move above 160. Let's look at the highs. If we get up towards that the highs that we had last week, perhaps we take a knock on, have a go at that 170 level, and then have another little break, have another little pop up.
Okay.
But yeah, otherwise, we're just going to see it moving sideways again.
Okay, so good morning, Stelios, if you're around.
Hello. I'm just listening to. I'm good. I'm listening to what Ryan is saying, and I kind of agree. The world's focus is now still on inflation. What central banks are going to do, and like Ryan said, Bailey of the Bank of England, he didn't even hint it. He said that we're going to act to counter inflation. Now, we've said this before. How does hiking rates actually make things move faster in the supply chain? It's they don't, but they have to show that they're doing something. And interestingly, I mean, I'm seeing I'm no longer a sterling market maker, so I don't have access to the markets I used to trade. But I'm seeing short sterling, so the futures, the interest rate futures, they're down like 25 basis points from December 21 onwards, which means a full hike being priced extra than when it was on Friday. So I've asked a friend who is a Sonia trader to tell me if this is true in terms of what rates are implying in terms of Sonia's, which are the overnight rates. They follow much closer the Bank of England rate. And but it seems that we're pricing 15 basis points in November, so we take rates to 25 basis points, and then another 25 in December. If that's true, then I think the market's getting a little bit ahead of itself. Central banks, they do want to show that they have some power to do something about this issue, although they don't. So they're going to talk the talk. They're going to try and taper and tighten and do whatever they can. The Bank of England is actually a weird situation because they're talking about hiking before they're tapering. So they want to hike rates, but they're continuing the purchases as they are, which is a little bit odd. But they have some
that is different than here, that's for sure.
Yeah, they have some weapons in their arsenal. They'll try to use them as they see fit. But frankly, tightening monetary supply in any way is probably just going to make things worse. And inflation is still going high. I was reading today that natural gas from Russia, Putin had hinted that he's going to increase supply to Europe, but from what I'm reading, the actual numbers say that nothing's changed, so the supply isn't changed. So to cut the long story short, everything is becoming more expensive. Energy is more expensive by the day, and when that happens, your products are going to be more expensive, and also shifting products from one country to another, and the supply chain is getting a lot more expensive. Shipping rates, everything. So people are saying, I was reading Peter Schiff's latest podcasts I was listening to, and he said, stock up on stuff because things are going to get a lot more expensive. And I think I mentioned here before, last week, was it? I have a friend who works in Belgium, and he's in a big chemicals company. They do all sorts of stuff, and he said to me, "There's going to be shortages of stuff, of detergents and things like that, which we can no longer produce because we don't have raw materials. We don't have the production facilities are shutting down." And it's like, dude, you're scaring me. But
I know. I'm very upset. It's there's a shortage of diapers here in the U.S. already. No, I'm telling you the truth. The
adult or
shortage. I'm
baby?
telling you the truth. Huh?
Adult or
Yeah.
baby?
They're gonna have to go back to cloth.
Yeah.
Any thoughts? And maybe I'll bring Blake. Yeah, bring Blake in on this.
Blake isn't here, I think. He's
Oh,
not going to be here today. No.
okay. Well,
From
then I'm.
Party time.
Huh? Oh,
Party
yeah.
time. Get the drinks
Okay.
cabinet open.
Well, what do you guys think? I mean, for the last several weeks, Aussie has been the most resilient currency, the strongest currency during, a small, even before the dollar kind of turned down a little bit. And today it's the opposite. Any comments on Aussie, giving up the leadership
So,
and now being a weak sister?
so it's same with CAD, right? CAD has been very
Yeah,
strong as
yeah,
well. I mean,
right.
commodity currencies have been doing well, but I wouldn't read into one day's action.
Okay.
I really wouldn't.
Because I know Canada held this 61.8 back of this whole rally so far.
Yeah.
And, we'll see. I mean, crude's making new highs. So,
If you look at CAD, Aussie, Kiwi, Norway, they're all, they've all done very well. And, as long as the prospects of inflation are high and, especially countries which are dependent on oil like Norway and Canada, their currencies should be performing well. But yeah, as I said before, a daily move for me, it's just noise.
okay.
Yields seem to be going up more. It's again, I don't think we've broken out. 10-year US. I
Oh,
have
yeah.
been saying for a
There it
while. I
is.
think 170. What was the high before? 170.
178.
There you go. That high.
Right up
Technically,
here.
technically, you need a break above that. Obviously, the thing that might happen, as markets usually do, is they take out the high or the low, they get everybody one way, and then they reverse and screw everybody basically. So, but for me, until we break that high, I'm not treating this as a legitimate move. Let's say clearly, with inflation going where it is, and with cost of goods and services going higher, you just cannot have yields at 130, 150. It's impossible for yields to stay there, especially when they're going to be hiking and tightening in general. So we have to keep an eye on bonds. I think we have been saying for a while, for years, that the bond market is probably the most, one of the biggest mispricings of risk that I've ever seen. I've been trading bonds for many years, and I've never seen this. You have junk bonds yielding 3% or 4%, whatever. That used to be the safest of the safe government bonds.
Right.
But anyway,
Yeah,
it is
junk.
what it is.
Yeah.
Yeah.
And S&Ps are pulling back after a pretty good recovery here. About 2 weeks ago, I got, out of my bearish positions in NASDAQ down here, And, every time it looks like it might be rolling over, I think, well, should I put something back on? It's when I didn't get the follow through. I thought this was going to be a big event, breaking these two lines, intersecting, when it just, turned out to be nothing. I got out. I kind of think we're going to new highs into year end. So I don't know what to do with it. Every time it breaks, I think, oh, I have to control myself from FOMO, but um, that's the way it looks to me. 14.5, that's a follow through point on USD NOK. We're getting, oh, that's Ronit. Okay.
That was on the Nasdaq,
Oh,
I think.
okay. All right.
We're getting so close now to we're 2 weeks away from the FOMC in November,
Oh,
and
yeah,
that's when they're actually going to tell us, okay, we're starting to taper, or we're going to be tapering on December. So we are now very close to them giving us specific information on their tightening, and if they don't, if they in any way are still vague and we're going to be monitoring, and yes, it might be appropriate to taper and this and that, but they don't actually tell us something, or they don't actually start with the tapering, then I think markets are going to fly. Because they're going to realize that, look, these guys know that they can't do anything about this situation. Really, they can't, and they're accepting it. So it's all a game of psychology now from the central banks, because I think
jawboning.
Yeah, jawboning, and they have to kind of, their job is very difficult because they have to calm the world down. That's what they have to do. And they're telling us from the beginning, inflation is transitory. Yeah, don't worry, we're going to be back to normal and this. And okay, it might take a little bit longer now. Bailey actually did say that this inflation is not going to be as transitory as initially thought. And, this is something that I think most central banks are going to adopt, and they're going to try to persuade us that this is going to be okay in the end. Don't worry about this 10% inflation on goods. It's going to be okay in 6 months. So
that's important for traders to understand, which way the price risk lies. The price risk lies not with announcing a taper, but if they don't announce a taper, that's where we'll get the bigger move this time. It's all, like you say, it's psychological. It's about these shifting mindsets among traders. I mean, we were saying last week, the taper doesn't matter right now to the markets. They don't care. They know it's coming, even if it's between November or December. They know it's coming. There's no real trade on that when they announce it. Is if they don't announce it, that's when we'll get the carnage.
Yes.
Okay. Any other thoughts that you guys have coming in here today? I don't know if Steve Volge's around today. Steve probably isn't. Is he?
He's probably picking up his son. No, it's okay. It's the three of us, I think.
Okay.
So what else?
Hey Ryan, you know what? We've never seen what you look at during the day. You want to share your charts, and so we can take a look at your setup?
I can't, because I've not got them on this machine. I've got them on my other machine. So I'll get.
Okay, I can take the screen. It's no problem. Let me take it, and
I'm gonna have to get a page on your trading view there.
Yeah. So the other thing which is moving, obviously, is cryptos, and Bitcoin is flirting with the highs, the all-time highs. Wow. And we've talked about crypto so many times. It's clearly still on a bullish trend after this. I mean, I really thought at the time when we broke below 40, I thought we were going to be when we were around here, in the 30s, I thought we were going to go right back down to the 15 to 20,000 level, but it was just the price action was way too strong. And in a way, cryptos are one of the few asset classes which are pricing properly this ridiculous increase in money supply. We're seeing this over the past few years. A dollar 20 years ago is worth a lot less than is worth a lot more than it is now, and it's going to continue like that. And cryptos are just exploding. And interestingly, it's Bitcoin and Ethereum which are leading. Okay, today they're down a little bit, but they have been leading the charge over the past days and weeks. But this is something I don't trade. I don't trade stuff I don't understand. But you have to look at levels, and Bitcoin has been trading quite technically. So these highs are going to be important, and we are what, 5% away or something like that. So that's definitely one to watch. Otherwise, we talked about yields.
Yeah, we've got a bit of inflation data out this week.
Oh, we do,
Canada,
yes. Canada and
UK,
yeah.
UK final readings from Europe. One thing I'll highlight: we've also got UK retail sales out this week. They're on Thursday, I believe. Yeah, 22nd.
Okay.
They're for September. Now, this is containing the month where we had all the petrol stations getting cleared out of, every juice and drop of petrol. So we could see a fairly decent jump in retail sales just on that factor. And they're looking a little low, the expectations of 0.5% rise. So I doubt it will be that much market moving, because it should be factored in what happened. But if we do get a big upside surprise, that might be you might get a little algo pop that's worth a fade.
Yeah, you have to get an outsized number though, really, for any of these kinds of numbers to move markets. But yeah, you're right. How is the situation actually there with petrol and all that? Is it still difficult to?
I think there's the odd place, in London and some of the more busier areas, if you like. Down here, it's nothing. It's all gone back to normal. Every garage has got petrol, and it's as if the last 3 weeks didn't happen.
So it was transitory. Good. Okay, I like that.
Yeah,
you know what? I'm really starting to look at the pound. I haven't traded FX much recently, because it's all been kind of in a range, or the stuff that I look at. But euro pound, and the way the market is pricing in all these hikes and everything on the Bank of England side, I really want to get long this. But I've Dale, you remember I've been saying this from the highs here. And 83, 82, 83. I think 83s I'm going to start, and I think these lows here, I mean, they look very powerful. And also the way the market's been very quick to price this hawkishness and these rate moves from the Bank of England. I think the risk now lies on them disappointing, and so I really want to start getting long this in the 83s. So keeping an eye on that.
Huge range for all these years.
Yeah, this is 5 years, right? So it's and the other thing, obviously, that I'm interested in is metals. And we are still kind of in no man's land in both silver and gold. Friends of mine who know that I'm bullish, they're asking me, "Oh, should I get in now?" I said, "Look, if you want to get long, I think you probably want to wait a little bit. There might it's exactly what I say here on Face every day. I think there probably will be a flush, maybe towards these lows in gold. And and the argument is, if there isn't, and we break out higher, well, the move then is going to be, I think, is going to be pretty large. So you miss the first 5%, whatever it is, 10%, and then but you catch the whole of the move afterwards.
But we should go to new highs if we come out of there.
I agree. And it's perfect, right? We had this huge impulsive move from forget about COVID. Look, COVID is a blip. We had this impulsive move from mid 18 all the way up from 1200, what was it, 1100 something. We almost doubled, and now we're correcting in a really nice flag, and I love it. Obviously, the more it stays in here, the less convincing it is for bulls, but I still think the shape of it and everything is still okay. So if we break out higher, I think we're taking out the highs. It's unavoidable. But being a trader, I always want to get as best an entry as I can, and that's why, as I've said before so many times, my positions are just under half of what I want them to be, and I'm waiting. Somebody's raising a hand. So are there other questions we can answer?
Yeah. So what's your level for gold for getting in? Raj is asking that in the comments.
There you go. Okay, so these lows here, 1680. I think I'm waiting to see if they're going to get tested. I think the most probable scenario is actually not the most probable, 50-50. I think 50% chance they get tested. We might even break below, get everybody caught, off guard. Longs get taken out, then shorts get, initiated, and then we just go. So I think I would probably start looking at, anything below 1700, between 1680 and 1700. I think I would start accumulating. Actually, I will start accumulating. So we're still not there, but we're not a million miles away. And silver, we have something similar. This zone here is between, say, 2170 and 2230 or something like that. That's where I want to get some more in. There is a chance. There's always a chance we might get back to this zone, like 19-ish. If we get there, that will be a miracle, but an absolute gift. So that's what I'm looking at for potential entry levels. But it takes a lot of patience. I'm not a day trader, and I just keep looking at these prices every day. You look at price action, look at the way it goes, the volume, everything, and you try to make the best decision you can. The other thing which has been an absolute monster is oil, and we've been talking about this for a while. I really thought that these 75 to 80 range would have held. It just went right through, and it's, in hindsight, is not surprising with commodities just screaming higher. Almost every commodity going higher, and it's just a train you don't want to get in front of. I don't dare short this at all.
So what do you think? What do you think this leg in oil's about? Because it hasn't really followed over the last few months. It hasn't really followed the other commodities. It's only been the last couple of weeks that we've really kicked on again. Obviously, you got all the OPEC messing around going on. But when you watch commodities and they've all been jumping, and you look at oil and you thought, well, it's not really getting on the train. But now all of a sudden it seems to be.
It's catching up, yeah.
Everyone's talking about $100. I put a story in the room yesterday, Wall Street Journal, saying that the 100 strike in options is the the most sought after strike.
Is it? Okay.
People planning for $200 as well. Getting options calls in for $200. And sometimes when you get the market all leaning one way,
that makes me want to sell it with both hands.
Well, exactly, but it also feeds the saps behind who think, oh, it's going to 200, and they'll start buying it blindly.
Well, you also get the hedging of the options, right? So if everybody's buying 100 calls or 150 or 200, then you got to hedge a delta, the guy who sold them, and it's pushing. It's a bit like Tesla stock.
Oh yeah. What's happening in the stock market? Yeah.
So, I mean, I wouldn't sell this. I mean, there's no way. But why is oil catching up now? I don't know. If anybody knows, I'd be very interested to hear it.
Quants.
Anyway, yeah.
All right, there are lots of bets. We're going. We have a very aware audience, attendees, and these guys do a lot of research, and we get a lot of good input from them. And they're saying that the December 22 is where there's bets on $200 oil. So that's over a year away.
Yeah.
I think it might take some type of major supply disruption to get up there, not just inflation. I think there'd have to be something
worse than now.
Going on. Well, something like Putin holding back, or something happening in the Straits of Hormuz. I just don't think we could get to 200 just out of a supply demand story right here. Maybe a crash in the dollar would help. But wow, we're headed for days that, most people aren't prepared. I mean, I'm not used to not being able to get anything I want at my fingertips. So this is a big change for people to have to wait. If you need a part, you can't get it done. This is, really going to test people. You talk about patience, about, waiting for an important part, and you can't even drive your car till you get it.
And that's a big effect. That's a big effect on the economy. People were marking the PMIs last week, and we've got the flash PMIs this week in Europe as well. PMIs dipping back. and people saying, oh, the economy is weakening, but it's why is the economy weakening? Is it weakening because demand's fallen? That's not the case. It's weakening because people can't physically produce the goods and fulfill orders. And that translates into lower activity. That's going to translate into lower GDP. But what it does mean is that when these issues get solved, you're going to get potentially a big snapback in economic activity. You get a big short-term jump in growth.
Yeah,
when it
because
all
of
comes back again.
demand that hasn't
Exactly,
been able to
pent-up
do
demand.
anything.
It's only if demand drops, then we're in trouble. Then you've got this high inflation, low demand, economic weakness, and good luck hiking rates into that, fellas.
Yeah, exactly.
Yeah, great. Great questions, everyone out there, and nice coverage by you two guys,
Thank you, Dale.
Ryan and Stel. Really, really nice coverage. And
Cheers, mate.
why don't we wrap it with what's a trade of the week for you guys coming in, Ryan? What do you think?
My trade, I want to get in on some long Aussie.
Long Aussie, buy
Yeah.
weakness, Aussie week today, maybe another 50 lower or something like that, Ryan?
Yeah, and I think anything down to the low 73s, I'm going to start building a position because I think the RBA are talking bollocks when they about their 2024.
Okay, so
rate
Stel,
hikes.
I don't think we're going to get to 82 EG yet this week. So
You never know. 83 we might get. That's the one I'm looking at
All right.
most intently.
All right, so we get to 83. Stel's going to be buying EG.
Yep.
And thank you guys very much for hanging out during Face with me. And I'll bring in our guest, Adam Turkmens, with us today. So stick around. Adam's got really has some insightful views and looks at the big picture. So Adam, welcome. Welcome back to Face, buddy. How are you? Waiting to hear your voice. Adam.
He's
How are you?
unmuted.
Yeah.
You guys able to hear me?
Oh, there
Got
we
you
go.
now, Adam.
Great. There.
How
Hey,
are you?
how I'm doing good. How are you guys doing?
Good. Nice to have you back. Welcome back. And you're going to share your screen button.
Yes, I am.
And I think I saw a tweet by you today. You were talking about, what you wanted to talk about. I know that you were bullish uranium, and it finally really hit the news, the move in uranium. So nice call. Nice call
Yeah.
on that, Adam.
Yeah, I got lucky on that. Uranium was such a. I'm actually skeptical of uranium going forward just because of the reflexivity of it and the I don't know, the market at this point, like energy, everything is so volatile and high in price that it's hard to know what's genuine right now or just like speculative excess.
Yeah. Okay. So is any of the supply chain constraints coming into your work? I know you look for contrarian things. I was just thinking if someone just mentioned here in chat. I'd say that consensus is it's going to be resolved, and I would say contrarian what someone just said, that it's going to persist for longer than most people think. Where do you come down on that?
Well, it's tricky because even with, I mean, the entire global economy, since the 70s, we've been in an age of surpluses. Globalization, basically air-conditioned and large haul shipping freight really changed the world ever since the 70s, 80s. And we haven't really seen the supply chain screech to a halt and then turn back on. So I genuinely think a lot of the inflation crowd is patting themselves on the back because they were wrong for a decade about predicting, like above trend inflation. But even if you had an economy pegged to gold, which, go back pre-1971, there were multiple periods where inflation broke out because of supply issues. That was the big problem, usually during wars. in U.S. history was that supplies would dry up really
Shortages,
quickly
yeah.
relative to demand. Yeah, and since
Yeah,
the
like World
70s,
War II, everyone turned into
yeah,
rubber, and they
exactly.
used wood
There's
on cars. That's how we came up with woodies, and yeah.
yeah,
So we saved everything and turned it into the war effort.
exactly. And right now today we're seeing not as an extreme of the war effort, but it's I don't see how there wouldn't have been inflation. And I remember last year talking with someone. I still think structural deflation is the plaguing of the world's problem more than inflation, because pretty much the two big drivers this year have been really, throttling markets have been energy and food. Well, the two big reasons those have really gone up in price so suddenly was because there have been really bad weather issues this year, and there was really bad supply side because of low prices. Um, and
Talking about
farmers were
grain.
grains were getting killed up until recently because, there were farmers dying because their soybeans and everything were so low price right before Trump left office. And then all of a sudden you had a total reorganization. You had China, after they dealt with their horrible African swine flu uh, crisis, they had to restock their pork supply, which takes a
Well,
lot of
they've
corn.
been stockpiling wheat for at least 5 years. So
Yeah,
I mean, the grain side they've been stockpiling for quite some time.
yeah, and they really stepped it up last year after they had to rebuild their entire hog supply. And so you have these factors that even if we were in a booming economy pegged to gold, I don't see how suddenly having supplies globally get whacked wouldn't push prices up. So to me, it was never really a big question of like a little bit above trend inflation. Now
Yeah.
that's
So it's
no,
not monetary inflation; it's supply shocks.
yeah. So yeah, like we've
Is
talked
that your
before.
point?
Yeah. There's the three types of the inflation: the demand side, supply side, and then the monetary. Throughout history, demand side has been that creeping inflation where you have like during periods of calm, usually there was no wars. The men weren't going off and dying, times of no plague. So the people were living longer and they were having more children at a earlier age. Well, when you have like we were saying before, the 70s, usually, up until like 1000 AD recorded history, we've seen that there's been just, little price changes of 1% a year. But over 150 years, that 1% adds up. That's what? That's probably like 400% compounded increase in price. And when you get to a point, historically, there would be the rising prices. It's like when we go to the grocery store, we'll be like, hey, things have gotten expensive. Like, I remember a decade ago, I was able to get way more for 100. It's not like we're doing it every single year, noticing it losing 20% of its value. It's like a slow creep.
Yeah, invisible depression.
Yeah. And then, but the really tricky part with that is historically, there's been, once the creeping inflation built up, there would be periods of like a supply issue. So, in the medieval days, it was usually a crop failure,
Yeah,
just like bad weather. And then all of a sudden, it would send grain
pestilence.
soaring. Yeah.
Right.
And then, population would usually, it would lead to revolts. Some of the largest empires collapsed during, creeping
Famines.
inflation periods,
Yeah.
grain shortages, and then you'd have marginal fields go online, and then usually there would be like a big war, and there'd be a huge population decline, or the plague came in the 1300s, late 1300s, and then all of a sudden there was a huge period of deflation because you
Okay,
suddenly have
so all we need now is like World War III and
unfortunately, that
to bring down the population.
So the problem now is that if you look at the inflation, let me see if I can pull it up. I was just looking at this actually recently. The CPIU, I think the chained, the history of.
So
Okay.
besides okay, go ahead.
So basically, up until 20, you could see CPI was very volatile. And there's actually a lot of studies that the CPI has overstated inflation by 1% per annum since World War II. And that's because of biases, you know, substitution bias, new quality bias, bundling bias. You know, like when you go to a supermarket and they just check the price of an egg, that's not, you know, accounting for, like, you know, when you go to like Safeway and it gives you, you know, those you know, coupon, you know, monthly, you know, you can save like $30 on groceries, or you get like you know, or like a computer, you buy one computer product, you can get, you know, Windows Office or whatever, you know, you get all those like bundling products with it. So the CPI hasn't really been a good measure of inflation relative to quality. And but even just using the CPI, we can see it was very volatile. Like, you know, you have spurts of 15, 20%, like we were saying, during periods of war, or in the 70s, when there was a lot of supply issues. Like a lot of the inflation in the 70s was the oil embargo. Exactly. And so even when we were on a gold standard, which there was monetary inflation, but the way monetary inflation amplifies demand side and supply side inflations is because you're putting more money in the economy. And when there's more money injected actually in the real economy, you're giving people more tickets to buy things. There's no more money for fewer goods. But what happened after the 70s so there's a great book called Financial
Paul Volcker happened after the 70s.
Paul Volcker. And there's a great book that really, it kind of puts it in perspective, because it wasn't the dollar breaking from gold that really led to the inflation. The CPI in the US, like we already see, before we broke from gold, between 1960 to 1970, the CPI had already risen 90%. I mean, it was already a big increase, even while we were pegged to gold. And yes, the US was doing its guns and butter. But the point is, like, why is it back then when the US had printed far less money and had even higher rates, was able to get more monetary inflation than post 2008, when they printed 4 trillion and they could barely keep it above 2%. Like if you look at the CPI, the average change in the CPI since the 80s, it's been mute. And it's been the longest, slowest decline. You know, it's known as like the second great deflation. The first one is the late 1800s, which like killed farmers and led to like the big populist movement, you know, in the US. But now we're having a thing where we're unpegged, but inflation was going down. And the central banks, no matter what they could do, they really underestimated the age of globalization, and they put their foot on the gas. And the byproduct of this, by them trying to stimulate inflation, because, you know, to make their debt cheaper, decrease debt in real terms. That's like the real big point of it, is that it created tons of speculative bubbles. So the monetary inflation acts as like a very volatile gas on the supply and demand side. But ever since the 80s, like I was saying, there's this book called Capitalizing on Crisis by Greta Krippner. And basically her thesis, which is, you know, very profound, is basically saying the US governments, pretty much the world economies, made too many entitlement promises after World War II, but growth was slowing. So even before inflation was picking up, you know, there was stagflation. There was, you know, there was like recession, the slower growth in before the 90s. It was like diminishing returns. Once we entered the third industrial revolution, which began in the 70s, there was diminishing returns, and we could see that in worker wages. You know, real worker wages compared to productivity, the bottom 90% of wages declined, and workers couldn't crystallize these gains as they could in the second industrial revolution, because the high hanging fruit were gone. So we got to a point that the Fed, real incomes were declining before the break from gold, and growth was slowing. So they had the easy solution: make debt cheaper. If an individual isn't going to be able to have his wages increase, then he should be able to borrow the difference. You know, the average family should go out, if they're making less money, then they can, you know, use their credit card to buy goods. So they had to hyper financialize the entire economy. And that's what we saw after the 80s. But for them doing this, they created a huge savings glut with the top 1%, because the 1% compounds their returns much faster than the average earnings have gone up. So you've had the richest 1% parking their money in banks, which kind of created a debt trap for the bottom 90%, because because when you have so much money supply, yields go down. When when the banks are loaded with money, yields go low, and that's the problem we've been seeing. Regardless of what the Fed's done, was that yields have gone down globally because there's been a savings glut and a dearth of investment. And that's today what we're seeing in reverse repo. There's the banks are telling, basically QE, it doesn't even, the QE is being nullified at this point because the banks are getting the money, the reserves, and then they're just sending it right back to the Fed. I mean, every night they're sending something 1.4 trillion back to the Fed every single night. A group of 70 to 90 banks, money markets, funds,
So what?
whatever.
Okay, so all right. So what's a contrarian play? Short energy, short gold. People that are buying inflation hedges. Is that your stance? Is that the contrarian play is to still bet on deflating ergs?
I personally think back in April when yields hit like 1.78, I went long bonds. I thought that was a great opportunity to go bonds and long dollar by short foreign currency, especially the short euro. I did just because I also did a short China thing, which worked out luckily because of the property sector. But this doesn't even include China right now, which is a
really
case.
deflating. Yeah.
Yeah, and that's the real big thing that the mainstream.
Okay, I ask almost everyone I interview. I want your opinion. You're very you've done a lot of research on this. So, back in 2008, in the great housing crash, Great Recession, the narrative was, well, China's still growing. They weren't as affected by toxic paper, and that their growth was going to help pull the world and the U.S. out of recession, right? So, we did. It was also, Fed action. So, the market can't have it both ways. And China's a much bigger percentage of GDP now than they were in 2008. So if they could pull us out of recession, can they pull us into one?
Oh, absolutely. And this is the thing about China. As this chart I have up, when you can see, up until 2008, China's main way for growth was exports. I mean, they were exporting some almost 40% of their GDP was exports. That's an insane number when you think about it. But after 2008, it crashed. Well, what happened? You can see in what picked up after 2008 was domestic credit from banks. So like you were saying, China pre-2008 was dumping their excess onto the rest of the world. They were running huge surpluses, forcing the West to absorb it with their deficits. Germany does the same thing today. Today, Euro and China, they're both running surpluses, trying to eke out growth, forcing a deficit country like the US to absorb it. But what happened after 2008, the rest of the world said, hey, we're tapped out. We're up to our neck in debt. We have to deleverage. Well, China had 2 points: cut back exports, which would have made growth and unemployment rise. Growth would have fallen in their country and unemployment would have risen, as factories had to turn off. But the CCP is very sensitive, their promise that's always known as like that undercover promise between the CCP and their people. As long as they, give them their growth and a job, they kind of turn a blind side to the loss of freedoms, the more conservative state. That's kind of been their promise after the Tiananmen Square incident. And so China said, okay, we're going to, instead of depending on the rest of the world to absorb our excess, we're going to do our own building boom. And President Xi in China, and this went on for a decade, but in 2019, when this tightening, deleveraging pretty much started, because if you look at China's bond defaults, it rose shockingly. It's been new records each year, but it really rose in 2018-19. And President Xi came out and he said, listen, there's 2 types of growth that we've had. The high quality growth, which has been exports and productivity, services, the growth we want. And then on the other side, there's been low quality growth, which has basically been just malinvestment.
Both cities.
And go cities. And as China's high quality growth diminished, which it has everywhere else in the world, they ended up focusing more on low quality growth, like their provinces, to make up for the difference. I mean, to put it in perspective, China's incremental capital output ratio relative to GDP, meaning basically capital efficiency for each dollar they spend, how much they get, how much money they have to spend for each unit of growth. It averaged 3 for the decade before 2008. Well, up until recently, it's hit 11. So they're spending $11 now for half the growth they got. That's like walking. So that's 3 times the incremental
So
output.
is there a play in their currency in the yuan here?
Well, so that's the big question. So like you were saying, now China has a huge low quality growth dependent economy, and Xi is not dependent, I'm sorry, he's very committed to trying to rebalance his economy. But that's going to come at a cost of growth, because real estate, it makes up about 30% of China's growth. China's real estate is about 3 times as big as US real estate market. So, and China alone between 2013 and 2018 drove 30% of global GDP. A lot of that came from commodities, which went to building these ghost cities. So as China deleverages, 70% of net assets of the average Chinese are in real estate, homes. Like that's their value. So imagine when falling prices whacked the U.S.
Well, they already have. I've heard values are down 40, 50%.
Oh yeah,
Since Evergrande. Okay.
Yeah, and they're going to go low. I don't see how they're not going to go lower as the China is forcing their property sector to deleverage. So not even accounting for the accounting with the decline in household values, because China's real growth is investment, not consumption driven. But like you were saying, what happens going forward? There's 2 ways. Will China try to make up for their declining growth? Because China's total factor productivity has declined over the last decade, like the world's. Like everywhere's looking for returns. You have a flood of money and a dearth of investment. Just economic returns have dried up, and China can't avoid that problem either. So A, does China go back to trying to export, like dumping their goods on the rest of the world to make up for the growth, which is very deflationary by them dumping their excess abroad, because that's by definition deflationary. When when you have such big surpluses, you're dumping more on the world than you're consuming yourself. But you already have Germany and the euro and other Asian economies trying to squeak out their growth through exports. And now if China does it, they're going to have to cut the yuan to do it, most likely, which will be very deflation. Like we saw in 2015, when they cut the yuan slightly, it sent world into almost a deflationary shock. Or the second solution is, does China empower their consumer, increase wages at home, and
sop it up?
Exactly. So they become the marginal growth engine. I mean, the consumer in the world. So I personally don't see them doing the second option, because China has repressed. They have very harsh, like compared to America, the consumer is very repressed in China, and in most fast, high growth, export driven economies follow that route. Like we saw it in the Soviet Union, we saw it in Japan. They focused on forcing their consumers to save. So then the banks, to spend less. So when you spend less, you're saving the difference. And when you have, in economic theory, savings equals investment. So when you have all that money in the banks, the state can come out and take easy funding to deploy where they want. So either China allows their consumer to start spending those savings, going into debt to fuel the rest of the world. That would be very inflationary, I'd imagine, because all of a sudden you have a population of 1 billion plus, 3 times the US, gobbling up whatever they can. Or you're going to have that economy, because China has a spending problem. Asia has a spending problem. They don't spend as much, and that's what the Western economies have been begging them to do for the last decade and decade plus, but we haven't seen it.
Okay, and we do the opposite because of financial repression, that it doesn't pay to save. So they must get a little bit of a yield over there. Let me ask you this. I think you're still on what I'm reading, still on the deflation bandwagon. One more swoosh, maybe, right, Adem?
Yeah.
But okay, with your narrative right now, and I know I'm not a premium subscriber, but I've given you some visibility here.
I appreciate it. Thank you.
But what's actionable with your thesis and narrative going forward, say into the end of the year? What are you looking to do?
So yeah, I was I made a pretty penny with uranium this year,
Right.
where that's old. We did the yield. I still like anytime.
And
the
if it's
yields
nothing, that's
rise.
fine too. I mean, there are times that maybe you don't see anything.
Yeah,
You're just so are we there?
right now I'm shorting commodities base metals because
Okay.
I'm like locking in long-term optionality like uranium. I would rather find overvalued like a Vail or etc. These over leveraged miners that are very dependent on commodities, China's demand, maybe the Australian
Okay.
currency, etc. Like I'm looking at locking in long-term optionality that long dated out of the money puts on these, that if I'm wrong in a year from now, it won't hurt me. I lose a couple thousand. But like in uranium, if you're right, that couple thousand can return 20-fold, and it makes up for those returns. That's why having optionality in this market is important, but never selling it. Obviously, you don't want to sell options and get your head blown off
Yeah.
if the trade, because markets are going to
Yeah.
be volatile. I think inflation is going to even like I'm not when I talk about like deflation, I'm just talking about structural deflation. I've written tons about inflation up until 2018. I was a big inflation's going to eat away at everything. It's going to erode. But then I really learned the difference between asset inflation, which is a
Yeah.
side effect of the Fed's policies,
Right.
because which is having to financialize the economy to make
There
up for the
is no
loss of
other
income.
alternative. Forcing
There
people
is
to
no
take
other
risk.
alternative. Exactly. There is no, like, the Fed can't, like, they obviously see this housing bubble here. They know it's
It's a shortage.
there. Exactly. It's a shortage. And if you actually look at so that leads to another thing in the US. There has been a horrible concentration of sectors, meaning like oligopolies. This chart I have, look at the decline of antitrust enforcement in the US. It's pretty much disappeared since the 80s.
Yeah.
So you're having, and then you had a M&A wave, mergers and acquisition. I wrote about this recently on my site, but there's been like a cartelization of US, and it has all the symptoms. It has above trend profits, declining net investment, higher artificial prices, squeezed wages, lower productivity. These are all the signs of an oligopoly. And if you look at it in the US, two major beer companies control 90% of the beer market.
Yeah.
There 80% of US households only have one or less option of like a modem, like
Yeah.
internet provider. And
Yeah.
we've gotten to a point where we have less freedoms. And when you have
Right.
a monopoly, the DOJ pretty much gave up on, the revolving door between governments and the private sector has gotten
And now
revolved
they're
faster
coming
and
back.
faster.
Do they have the wrong target with Facebook and Google?
It's
And they
too late. It's at this point, like,
Yeah.
it's jawboning in my opinion, because if you
All
look
right.
at how many people left Google that worked in Obama's office, it was tons of them. In the Bush administration, there went from over 100 defense contractors in the 90s to now there's just 9 that are the most powerful. Like, everything is consolidated. If you
Yeah.
look at new public firms, the amount of public stocks in the indexes fell from a peak of 8,000 in the late 90s. It fell in half today. So we're seeing big companies get bigger by absorbing competition, and then they're raising, then the lobby dollars have exploded because these firms are lobbying to erect barriers of entry, which prevents competition. And when you don't have competition, you have declining wages, declining net investment, lower productivity, squeezed wages, and all that other nasty stuff. So
Yeah.
that's another problem that is leading to inflation, because they're restricting supply on purpose to keep their margins artificial. So we do have inflation problem, rising price problem in this country for sure, but it's not monetary, because monetary, if you look at bank loans and leases, like how much banks have to lend money to create money in our modern financial system. And bank lending has declined like very bad compared over the last 4 decades. And it's like what we were saying, since the 1970s, we can't escape diminishing and economic returns just falling lower. It's a global problem. What China does going forward will probably be very important, but I don't see them suddenly unleashing their consumer to change, or it won't happen that fast because the power elites who got rich off exports and infrastructure are already in place. So, historically, it's come in a very nasty fight when there's a big rebalancing like we saw in Japan.
Okay, so Adem looking for China would help Adem's position if China kept dumping commodities. So thank you so much. Oh, okay, so here's your website.
Oh yeah, this is just my website if anyone's interested catching up
Okay.
with
What's
whatever
the
content I put
address?
out. Speculatorsanonymous.com, and then
Okay.
my Twitter handle is just at Radical Adam.
Okay, and you also have a premium for getting your calls and your trades.
Yeah, for
Okay.
plays and book notes, packets, all that stuff. I usually
Yeah.
just do book reviews because people don't have
Right.
the time
The-
to
the-
read an 800
No,
page
they're just
economic
lazy.
book.
They're
Yeah,
lazy.
it can be pretty
You could be
dry.
nice and say they don't have time. They have time. They're just lazy. So anyway, I hope you have a great fall trading season, or your optionalities blow up in your favor, Adem. And I really appreciate you coming here and sharing your. You're one of the smartest guys I know for such a young age. I'm always look forward to talking to you.
Yeah, I definitely appreciate it, Dale. Thanks for having me on.
All right, so my trading warrior brother, Adem Tumerkin, and you could find him. Show the website one more time, Adem, so when people look at the video, they could see it and know how to find it. And do you have any kind of newsletter that you put out on this too?
Yeah, so
Articles?
I just do articles and stuff, and I also have a reading list on my site for anyone who's
Okay.
interested. I know
For
it's
all
hard
the
to find
unlazy people that might
all
actually
these
sit down
books.
I
Yeah.
was reading a book Friday. You know why?
Why?
My internet went down and
Oh
cable went
wow.
down. Yeah, so I was
Yeah,
forced to read.
I try to
Anyway.
read. I try to read a couple hours every night, but I'm a slow
Yeah.
reader because I write notes. It helps me remember better, but it
Yeah.
makes things very slow.
All right. Well, I appreciate you starting off our week, Adem, and uh, I'm going to be keeping an eye. I'm going to start charting uranium and see if I see anything there as well. So I appreciate you sharing your work with us today.
Great, thanks, Dale.
All right, that's a wrap, everyone. Remember, don't just count your optionality, count your blessings. We'll see everyone for Turnaround Tuesday. Adios, and follow Adam at Radical Adam and on Twitter, and you have his website address. Check him out. Adios.